The S&P 500 has been on a hot streak lately. Over the past 5 years alone, it has more than doubled investors' money, earning them over 15% average annual total returns. REITs, on the other hand, have done really poorly over the last 5 years. Their share prices have been steadily declining, and they've been in a quasi-bear market this entire time. As a result, a lot of investors are now happily investing in the S&P 500 and ignoring REITs. But this ignores that the last 5 years were highly unusual. We first had the pandemic, which negatively hurt the REIT sector. Then we had the historic surge in interest rates, which once again hurt the REIT sector. And then thirdly, we are now going through the AI revolution, which is a huge tailwind for tech stocks. As a result, the S&P 500 saw its PE multiple expand to historic highs, even as REITs saw their valuation multiples drop to the lowest level in over 10 years. This explains their relatively poor recent performance, but if we extend our time period, we find that REITs have actually outperformed the S&P 500 and even tech stocks over the last 50 plus years. I think that going forward, REITs should regain their leads as their valuations are now historically low, and I expect a lot of capital to flow back into the REIT sector as interest rates are cut down to lower levels. Hey, this is Yossi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss two specific REITs I expect to crush the returns of the S&P 500 over the next 5 to 10 years. These are not some small, highly leveraged, speculative REITs. On the contrary, these are blue chip companies with investment grade rated balance sheets, steady growth prospects, and long track records of steady outperformance. Before I get started, if you enjoy this type of content, can you please do me a huge favor and click the like button, subscribe to your channel. It helps me tremendously to keep on growing. Thanks so much in advance. Okay, so the first REIT I'm going to discuss is called East Group Properties, ticker symbol EGP. This is one of my favorite industrial REITs today, and it has a long track record of significant outperformance relative to the S&P 500. It has done so well over time because it owns primarily Class A, last mile urban properties that enjoy high barriers to entry, especially in rapidly growing Sunbelt markets like Texas and Florida. These properties have historically greatly benefited from the growth of e-commerce like companies like Amazon, but also from the growing trend of onshoring as well as the rapid population growth of these Sunbelt markets. It has allowed it to grow its rents, its occupancy rates, all while developing new properties, earning high spreads over its cost of capital. And I think that the REIT is well positioned to keep replicating the same business model going forward. Firstly, the fundamentals of its properties remain strong. Most of its properties have lease rates that are deeply below market, and while some sectors of the industrial property sector are today oversupplied, this is not the case for the type of properties that East Group Properties specializes in. I'll put a chart on the screen where you'll see that these smaller urban industrial properties have not seen the same spike in new supply, and even today their fundamentals remains relatively strong. But while the supply remains limited, we expect the demand going forward to keep on increasing, especially as the AI revolution takes hold. We expect it to accelerate the three trends that I mentioned earlier that have historically made East Group so successful. The first trend was that of e-commerce. We expect AI to accelerate it as it will make marketing a lot more powerful and more personalized. Secondly, we expect it to also accelerate the growing trend of onshoring as AI and robotics will make it a lot cheaper to produce goods domestically, leading to a lot of companies bringing back larger portions of their supply chains from countries like China and Mexico back to the USA. And then thirdly, we expect it to also further accelerate the growing migration trends from expensive coastal markets to business-friendlier and more tax-friendly Sunbelt markets. Today, the REIT has a historically strong balance sheet with a very low LTV of just about 10%, which leaves significant capacity for it to take on new debt to start new development projects, earning high spreads over its cost of capital. As a result, analysts today predict that the REIT will keep growing its FFO per share at a high single-digit growth rate over the coming many years, leading to $12.50 of FFO per share by 2029. Yet, despite enjoying these rapid growth prospects, the company is today trading at just about 17 times today's FFO and about 12.5 times 2029 FFO. This means that the REIT is today even cheaper than at the bottom of the pandemic crash. Just for context, this company traded at 35 times FFO in early 2022, yet today trades just at a small fraction of that, and it's quite unbelievable how much of a difference just a few years can make. I think that 35 times was a bit rich. This was because interest rates were very low, the demand for industrial properties were booming in the post-pandemic world, so that was a bit expensive. But similarly today, I think that 17 times is too low for a REIT with so little leverage, almost no leverage, just a 10% LTV and rapid growth prospects. I think that fair value is likely somewhere in the middle ground at about 25 times FFO. This means that the REIT has about 30% upside to our fair value target, and while you wait, you're earning a 3.5% dividend yield. The company is expected to keep growing its FFO per share about 8% per year. Just between the yield and the dividend, you can expect to earn double-digit total returns. Add to that some upsides, and you have a very attractive story, and we expect further outperformance from this REIT for many years to come. This is a REIT that has steadily outperformed the S&P 500 for 30 plus years, and I just don't see why this outperformance would end anytime soon, especially given that its valuation is actually historically low, its balance sheet is historically strong, and the AI revolution is set to greatly benefit this specific REIT. For this reason, we own it in our retirement portfolio at High Yield Landlord. By the way, if you want to access our full portfolio, you can join us for a 2-week free trial at High Yield Landlord. This means that you won't be charged anything in the first 14 days. You can join, access my portfolio and our research, see if you like it. If it's not for you, you can cancel anytime, no questions asked. It will be the first link in the description of this video. Then the second REIT on my list today is Sun Communities, ticker symbol SUI. This is also one of my favorite REITs at High Yield Landlord. It's one of our favorite residential REITs. It specializes in manufactured housing communities and RV parks, and it has also very significantly outperformed the S&P 500 ever since it went public nearly 30 years ago. We think that this REIT is especially well positioned today because it's just recently sold its marina business to Blackstone, which is a major private equity player, and this allowed it to significantly deleverage its balance sheet, buy back shares, and issue a special dividend. This has left the REIT with its strongest assets, which are the RV parks, the manufactured housing communities. These generate steadier and faster growing cash flow. It has also left the REIT with a stronger balance sheet, which combined together I expect to accelerate its growth rate going forward. So the REIT is now superior in quality relative to what it used to be, but despite that, it's today trading at a significant discount relative to its historic valuation. For context, this REIT used to trade at 33 times FFO just a couple of years ago, and yet right now you can buy it at 17 times FFO despite having improved in quality. Once again, I think that 33 times in early 2022 was too high, but I also think that 17 times today is too low. The fair value is likely somewhere in the middle at about 25 times FFO. So the story is quite similar to that of EastGroup Properties. The company is offering a 3.5% dividend yield. Yes, that's not a particularly high yield, but that's because the REIT has very low leverage. It focuses on low cap rate properties. It retains a significant portion of its cash flow to reinvest in growth as well as in buybacks. On top of that yield, then you're getting a high single-digit growth rate of about 8%. Combined together, the yield and the growth, you're getting to double-digit total returns of about 12% annually. And then you add to that about 30% upside, likely realized over the coming years as interest rates are cut. And I think that this should be more than enough to keep outperforming the S&P 500, just like this REIT has done for now about 30 years. So yes, the S&P 500 has been on a hot streak lately, but investors should be careful to not extrapolate recent trends far into the future. These high returns were realized largely because of significant valuation multiple expansion. REITs, on the other hand, saw their valuation multiples contract significantly, and I think that this positions them for strong recovery and significant outperformance relative to the S&P 500 going forward. But not all REITs are created equal. Some will perform a lot better than others, and I think that EastGroup Properties and Sun Communities are good examples of that, but there are many other REITs that we expect to significantly beat the market. If you want to access our best research, once again, you can join High Yield Landlord for a 2-week free trial. You won't be charged anything the first 14 days. You can cancel, no questions asked at any times, with the first link in the description of this video. Now, let me know in the comment section what other REITs you expect to significantly outperform the S&P 500 going forward. I'm very curious to hear your thoughts. Once more, if you could click the like button, subscribe to your channel, will help me a lot. Thanks so much, and see you at my next one. Bye-bye.